This moving average strategy only works after the market tricks the wrong traders first. But the second you apply this one hidden liquidity rule, it transforms into a system that averages 2.8 R per trade. You already know the moving average breakout. Price breaks above, and you go long. It breaks below, you go short. You've seen it work in every textbook example. But here's what those textbooks don't show you. Watch this. Price breaks below the 50 moving average during a clear uptrend. Retail traders see this candle and panic sell. This looks like the trend is ending. Now watch what happens next. Price immediately reverses, rips back above the line, keeps climbing in the original direction. Every short is now trapped. Their stops are triggering above the moving average, and the momentum from their exits is pushing price even higher. This isn't a random failure. This is how the market is designed to work. Only about 15 to 20% of moving average breakouts actually play out like the textbooks show. The other 80%, they look exactly like what I just showed you, a liquidity trap. The moving average breakout doesn't fail randomly. It fails by design. Let me explain. Here is the mechanics of the trap. When price is trending up above the 50 MA, where do most traders put their stops? Right below the moving average. Because if price breaks below, the uptrend is over. And when price is trending down below the 50 MA, stops are clustered right above it. So you end up with this situation. Both sides of the moving average have orders stacked up, waiting to be triggered. And big players know exactly where those orders are sitting. Watch this. Price is moving down, sitting below the 50 moving average. Shorts are stacked up, and their stops are all clustered above the moving average. Now watch. Price spikes above the MA. Those stops trigger. The buying from those stop outs creates a brief surge higher, but there's no real conviction behind that move. It's just stops getting hit, and the moment that wave of buying is absorbed, price reverses right back down, continues the original trend even harder. That spike above the line wasn't a trend change. It was a liquidity grab designed to trap traders and fuel the next leg of the real move. Once you see this pattern, you'll notice it everywhere, and instead of getting trapped by it, you can position yourself on the right side. Here's exactly what I need to see before I take this trade. First thing, the trend has to be obvious. I mean really obvious. Higher highs and higher lows that are crystal clear for longs. Lower highs and lower lows with no ambiguity for shorts. If I can't see the trend in 3 seconds, I don't trade it. Next, I need a brief break of the 50 MA. And I mean brief. I look for 1 to 3 candles. If it hits more than 5 candles, I usually walk away. We want a panic dip, not a new trend. Watch this. Price dips below the line, sits there for 2 candles, then snaps right back above. That's the pattern I'm looking for. If price breaks the MA and stays on the wrong side for more than 5 candles, that's not a false breakout. That might be a real trend change. I'm looking for the quick fakeouts that trap traders and reverse fast. Now here's the confirmation that tells me the move is fake. Volume. When I check the volume on that breakdown, it should be lower than average. Real breakdowns have conviction behind them. Lots of traders piling in. Big volume bars. Fake ones are quiet. The volume bar is smaller. Nobody's actually committing to this move. And the last piece, this is the strongest signal I can get. A liquidity run. Watch this. Price doesn't just dip below the line. It goes further and takes out this previous swing low. See that level? That's where traders had their stops. The market just swept those stops, ate them for breakfast, and now it's ready to reverse. When I see a liquidity run combined with the other 3 pieces, obvious trend, brief break, low volume, I'm taking that trade with confidence. Let me show you exactly how I pull the trigger. Once all 4 pieces are present, I wait for price to cross back to the correct side of the moving average. In an uptrend, that means waiting for price to close back above the 50 MA after the false breakdown. That candle close is my entry signal. In a downtrend, I wait for price to close back below it after the false spike higher. My stop goes just beyond the liquidity sweep. If price took out a swing low during the trap, my stop goes right below that low. Tight stop, but protected behind the level that already got swept. For targets, I'm looking at the next significant structure level in the direction of the trend. Previous highs in an uptrend, previous lows in a downtrend. Usually gives me at least 2R, often more. Let me walk you through real examples so you can see exactly what this looks like. Gold price has been climbing steadily. The 50 moving average is rising right along with it. Higher highs, higher lows, obvious structure breaks to the upside. Now watch this move. Price dips below the 50 moving average for just a couple of candles. Check the volume. Surprisingly low for what looks like a breakdown. And see this level here. Price swept right below it. Grabbed that liquidity. All 4 pieces. Obvious trend. Brief break. Low volume. Liquidity run. When price closed back above the line, that was my entry. Stop below the liquidity sweep. Target at the next resistance level. Look what happened. Price reversed and pushed all the way back up. The traders who shorted the breakdown got crushed. Their stop-outs helped fuel this rally. Second example, index in a downtrend. Price has been falling for the whole day. Lower highs, lower lows, multiple structure breaks to the downside. Then this happens. Price spikes above the 50 moving average. Looks like a reversal. But check the volume. It's lower than average, with no real conviction. And watch this level here. Price ran right above it before reversing. That's a liquidity sweep trapping breakout buyers. When price closed back below the line, that's your signal. Stop above the liquidity run. Target at the next support. And look at that. The breakout was a complete trap. Another uptrend. Higher highs, higher lows, strong momentum to the upside. Price is respecting the 50 MA as dynamic support. Now this, a quick nosedive below the moving average. Price even takes out this previous swing low. That's the liquidity run. And check the volume during this drop. Notably lower than the average bars around it. Classic false breakdown. You know the setup by now. When price closes back above the 50 line, that's the entry. Another one, a forex pair in a downtrend. I just want to show you this liquidity sweep strategy works on most markets. Prolonged downward trend. Price staying below the 50 moving average consistently. Then this spike higher. Price briefly pops above the moving average and sweeps this level here. Volume is low, duration is 3 candles, and the liquidity run is clear as day. When price dropped back below the line, your entry is valid. Notice how the market continues its initial trend and accelerates even harder after the trap is complete. You've now seen this pattern across 4 different markets. The setup works the same way every time. That's what makes it reliable. But please don't force the setup. This liquidity pattern shows up a few times per day across the markets I watch. If all 4 pieces aren't there, obvious trend, brief break below the moving average, low volume, liquidity run, I don't trade, period. The best setups are obvious. If you're squinting to see it, it's not there. And one more thing, if volume is heavy on the breakout, be careful. That actually might be a real trend change, not a trap. Light volume is your confirmation that the move is fake. And remember, Brief means brief. 1 to 5 candles against the moving average, then reversal. If price stays on the wrong side for an extended period, the trend might actually be changing. Again, don't force it. Here's what I want you to do right now. Open your charts, pull up the 50-period moving average, and find the false breakouts from the last days. Check the volume. Look for the liquidity sweep. See how the trade would have played out. If you can spot them easily, you understand this strategy. If you want to go even deeper on liquidity hunting, I break down the advanced concepts in this video right here. That's your next step. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for.